Hello and welcome to chapter number 4, completing the accounting cycle and classifying accounts. So the steps that we have taken so far in chapter 1 to 2, we studied from analyzing transaction, journalizing, posting, and preparing an adjusted trial balance. In chapter 3, we studied couple of adjustments to prepare an adjusted trial balance. So in chapter 4, we're going to prepare post-closing trial balance. We're going to close and then we're going to move on to preparing our financial statements. So let's start. The worksheets, an optional working paper that can be used to simplify the preparation of financial statement. It is prepared before adjusting entries are made, captures the entire accounting process, often used by auditors, helpful in preventing errors. So this is the example of a blank worksheet that is given. Steps that they have given are enter the unadjusted trial balance, enter adjustments, prepare adjusted trial balance, extend adjusted trial balance to financial statements column, enter profit or loss, balance sheet, financial statement columns, and prepare financial statements. So we are going to do all of those. So this is the example of the unadjusted trial balance. So you create an unadjusted trial balance. This is the one that you have created from all your journal entries. Then you pass on some adjustments like the ones that we discussed over here. And then after adding and subtracting the adjustments, you get the final result in this right corner over here. And we're going to do the whole thing. Right now, I'm going to give you the basics of how it works. Then we'll jump into it and we'll do it. And this is step 2, the entering of adjustments. So this is how you would do the adjustments. For example, B, A, C 200 comes in front of accumulated depreciation equipment. 250 is debit. So this is credit and debit. They are opposite. So the net result should be 2750 coming over here. 3600 is debit, 1050 is credit, which means it's being reduced. So the debit balance is going to be 3600 minus 1050 and debit balance. So that's how it's done. So this is what they've done. So I gave the example of 3000 and 250 and I said that it would be a credit balance. So the balance is credit and it's coming to 1750. So how do we know that the balance is going to be debit or credit? If 3000, whichever is greater, that's the column in which you're going to put your balance. 3000 is a bigger amount, which is credit. 250 is a smaller amount, which is debit. If you minus 250 from 3000, 2750 is left, which means this balance is bigger. So you bring the result over here as 2750. If this had been 3250, then this 3250 would have been bigger, and which means the balance net result would have been debit because debit amount is bigger, credit amount is smaller. So you subtract from each other and the amount you get, you would take to the column of the bigger amount. If the bigger amount is debit, you take the difference in the debit. If the bigger amount is in the credit column, you take the difference in the credit column. That's the simple way of explaining it. And then there are additional adjustments we never accounted for. So by adding these adjustments, they're saying it means these are the ones that we forgot to enter. There was error, there was omission, or maybe we didn't have the information at the time the unadjusted trial balance this part was created. So we pass those entries in the adjustment period like I discussed in the previous tutorial from January 1st to 31st January of the coming year. And then that's how we reach the final totals. And step number 4, extend adjusted amounts to the statement columns. That's what we just did. And then enter profit or loss and balance sheet, final statement column. Whatever the profits are coming, we would do that and get the totals. Prepare financial statements from the worksheet information. Then we would use this balance sheet statement of changes in equity type of thing. We would use that and we would prepare financial statement from that. The closing process occurs at the end of an accounting period after financial statements are prepared. Closing entries reset revenues, expense, and withdrawal account balances to zero at the end of the period. Update the capital accounts. Don't you just have to memorize this one because in reality, look, I worked with Big Four corporations like Pri- PricewaterhouseCoopers, Deloitte, Ernst& Young. I worked with KPMG. I've worked with many other in the top 10 like BDO as well, and I can assure you that what they're saying over here, this does not actually happen the way they are saying it. I don't know who wrote the book. Four steps closing process that is not used in reality, but since this is part of your book, this is part of your syllabus, we are going to go through it because you're probably going to get asked a question, hey, what are the closing steps? So close revenue accounts to income summary account. Just memorize it. Close expense accounts to income summary account. Memorize. Close income summary account to owner's capital account. Close drawings withdrawals account to capital account. So you just memorize it. REIT. Read. Only temporary accounts are closed, resulting in a reset to zero for the next accounting period. Permanent account balances carry into the next accounting period. So what they're saying is that temporary accounts are revenue, expenses, withdrawals, and income summary. The same, the read accounts. And the permanent accounts, they're calling assets, liability, and owner's capital. Okay, so closing revenue accounts to income summary. Food services revenue. So they passed a journal entry, and you're going to use the journal entry to create what these are the ledgers, like we discussed in the second tutorial, the second lecture video, that it's incomes, that these are the ledgers. Food service revenue 5850. So when there's revenue, it we do it on the credit. Teaching revenue 300. Again, we take it in the credit, and income summary is 6150, so we take it in the credit side as well. So the difference is 5850, 300 we post it on the other side, and these two match this one, so that's how we get this number. I know that was a very horrible explanation, but your book is weird. Income summary 4155, depreciation expense 200. This is one journal entry again. Total income summary they've taken over here, and these are all the expenses, and they've taken the expenses and they've totaled it and done the exact opposite. So you create all this ledger account, and whatever that is in the opposite end, you take that in the income summary, and that's what they've done. Income summary 1995, Haley Walker Capital 1995. Haley Walker is the owner. So whatever the income is, we're going to take it to Haley Walker's capital account. So they've done the ledger entry, and I will show you how it's actually done. Just give me 2 minutes. First, let me go through a couple of these slides and then we'll move over and we'll do what's happening. Haley Walker Capital 600, and she does a withdrawal 600. So our capital, if you remember from the first tutorial, was $10,000. We add this profit of 1995, but her withdrawal is subtracted 600, and we create a separate ledger for her withdrawals as well, and that's how it's balanced. So the four-step closing process: close temporary accounts with credit balances to income summary, close temporary accounts with debit balance to income summary, close income summary account to owner's capital, and the same thing, 1, 2, 3, and 4. After closing all temporary accounts, revenue, expenses, withdrawal accounts will have zero balances. The capital account will be updated to reflect profit and loss and withdrawals from period just ending. All of the accounts will be unchanged. So they're saying the revenue, expense, and withdrawal accounts will have zero balances. If you look over here, this is the withdrawal account. What is the balance? Zero. And it's all being closed in the income means basically what they're doing is they're closing it by passing a reversal entry. the balance for insurance expense was 100 debit. So you credit it by 100 and you can see insurance expense. This side is the credit side. 100 is coming over here. So the balance is nil, nil. They're closing it by nil. And then whatever the amount that is coming, they take it into the income summary account and they post the total balance over here. That creates a difference, 1995. And that difference is being taken into the Haley Walker Capital account. 1995 is coming over here, and that's how they get their balance of 11,995. And they said close it in the capital account. Remember, step close income summary account to owner's capital account. So this is that step. They take the difference that generated over here and they put it in the Haley Walker Capital account. And the withdrawal account is treated separately. Remember, they said the step was close drawing withdrawal account to capital account. So again, this is the capital account. You close it by doing the exact opposite, 600 here, 600 there, and that's how the balances are closed. A list of permanent account and the balances after closing entries are journalized and posted. It verifies that total debit is equal to total credit. For permanent account, all temporary accounts have zero balances. So here's the mini quiz. Closing the temporary accounts at the end of each accounting period serves to transfer the effects of these accounts to proper equity account on the balance sheet, prepares the or all of the above. So the answer to that is all of the above. A classified balance sheet organizes assets and liabilities into important subgroups, provides users with more useful information for decision making. And what comes in the assets? Current assets, non-current investment, property, plant, equipment, tangible asset, and the liabilities and equity side, current liability, non-current liability, and equity. And this is what it's supposed to look like. Current assets are assets that are expected to be sold, collected, or used within the longer of 1 year or the company's operating cycle. And this is the operating cycle for a service company and a merchandising company: cash on hand, cash paid to employees, services sold to customers, and that service sold to customer leads to customers paying for service, and then that generates cash and so on and so forth. And same for the operating cycle for the merchandising company. Non-current investments are held for more than 1 year on operating cycle. Non-current investment. So there are two types of assets in the assets: current assets, non-current assets, or long-lived asset as they're called. Long-lived assets is anything that has a life more than 1 year, and current assets are the one which have a life of only 1 year. Property, plant, and equipment are tangible assets used for more than one accounting period to produce or sell products and services. Intangible assets are long-term resources used to produce or sell products and services. They lack physical form. Current liabilities are obligations due to be paid or settled within the longer of 1 year or the company's operating cycle. Non-current liabilities are obligations due beyond the longer of 1 year or the company's operating cycle. Equity is the owner's claim on the asset of a company. That's just the definition. So here comes the review. What classes of assets and liabilities are shown on a typical classified balance sheet? Current assets, non-current investments, property, plant, and equipment, intangible assets, current liabilities, non-current liabilities. Current ratio, a ratio that is used to evaluate company's ability to pay its short-term obligation. Okay, so the ratio portion we will do later. Reversing entry, appendix, summary. Terrible. So let's now jump into what I was saying that I'm going to do for you. This is Excel, and I'm going to actually create some financial statements for you to show you how it's actually done. So I'm going to bring a couple of journal entries over here, and these are the journal entries that I'm going to pass. And I'm going to show how to create a financial statement. So the name of my company is Legacy International Journal and General Journal for the year ended 30th June 2024. My first entry is started business with 500,000, and I'm going to build a table over here. Control T, Okay. The first one is going to be date, description, and the most important thing is account. I'm just going to show you how it's done. Debit, credit, some details. Okay. Okie dokie. Okay. So on 1st July 2025, we started business with cash. Started business with cash. I want you to do this while I'm doing it. You can do it on a excuse me, paper pencil. So the first thing that is going to hit is cash. Cash account, I'm going to say I'm hitting the cash account, meaning I'm affecting the cash account. So starting business with cash would mean that you have taken the money out from your pocket and taken it and invested in the business. So cash is increasing, and we have a rule. Uh, I'm going to write the rules over here. Asset, liabilities, revenue, expense, which I did in I think the first tutorial as well, if you have seen it. And we're going to look at these rules. And here is debit. This is the most confusing concept, and if you get around this, I think you've managed the account. Debit and credit. So if an asset increases, I'm going to represent with plus minus. If an asset increases, it's called debit. Oops. If an asset decreases, it's called credit. Oh, Alt HAC. It will all be now centralized. Bold. When a liability increases, it's called credit. When a liability decreases, it acts the exact, because asset and liabilities are the opposite of each other. So naturally, when they would when we would be doing the accounting for that, they would be moving in the opposite direction to each other. So when an asset increases, it is debit. When a liability increases, it is credit, and vice versa for each other. Revenue. So when a revenue increases, it's a credit, and when a revenue decreases, it's a debit. Every time they tell you, okay, the revenue has decreased, you're going to call that transaction, it's a debit transaction. You're not going to say what does debit or increase, decrease, because debit and credit are automatically deciding whether they are increasing or decreasing. Your job is to just follow the debit and credit. If it increases, without thinking, revenue, if revenue is increasing, you would call it credit. If the revenue is decreasing, just call it debit. That's how you're going to do it. Debit comes on left, credit comes on right. And this, you're going to put the amount on the debit, you're going to put the amount on the credit, and these are the rules to follow. Now comes expenses. When an expense and asset act in the same way. So when an expense increases, you call it debit. When an expense decreases, you're gonna call it credit. Equity acts in the same way as liability and revenue. So when equity increases, it's a credit. When an equity decreases, it's a debit. And there it is. So I'm going to color code them so that it's easier for you to understand. Liability, revenue, and expenses have the same rule. Expense and assets have the same rule. And this this is what you just have to remember. Alt H border all. Okay. Alt H border thick. Y. Alt H border thick. Delete. Alt H border thick. There you go. Started business with cash. So cash is actually in you when you're going to pass journal entries, you're going to think from the point of view of the business, not from your point of view. You're going to separate yourself from the business and think about it. Cash is increasing in the business, so it should be cash is an asset. And also the second thing that you have to do is identify what each of the item is actually. Is it an asset or uh, is it a liability? Is it a revenue? Is it an expense? So what you have to do is that first of all, identify what that item is, step number one. Step number two, you have to identify what is happening. Is it increasing or is it decreasing? Step number three, you're going to look at this graph and you're going to follow it. If it's asset and it's increasing, debit. Cash is an asset. By nature, it's an asset. If you have it, it's an asset, right? So it's increasing. Started business with $500,000 cash. It's increasing. So I'm going to put this amount under debit. Alt HK, Alt HOI. Those are the Excel shortcuts I just memorized. Now, same thing. And another thing, all transactions have two legs. So step number one, identify the nature of item in discussion. For example, cash. What is cash? Oops. Identify the nature of item in discussion. Cash is the item in discussion. So what is happening? What is it? Is it an asset, liability, revenue, expense? Step number two, um, identify according to chart whether item is increasing or decreasing. Step number three, identify if they are debit, oops, debit or credit. What is wrong with me? Sorry about that. Couple of typos here and there. And step number four, yeah, that's it. Identify if they are debit or credit. And step number four, all transactions have two legs or two sides. If something is coming, something is going. Something is increasing, oh, something is decreasing. So you have to understand that if it's one leg you identified that started business with $500,000 cash, so which means cash is increasing. But what is the second effect of it? All items have two, all transactions have two legs, two sides, or you can call it two sides or two effects. So whatever you would want to call it, two legs, two sides, or two effects. So the second effect is if you're bringing $500,000 cash in a business, that means it's a capital investment. Your capital is also increasing at the same time, right? So I'm going to do, and the table has come down, move. That is why I like tables. Started business with cash and capital. Capital is also increasing. Cash is increasing. Capital is also increasing. for the business. It's a capital injection. Isn't that what they say? Hey, injected $500,000 cash in business. So that is capital injection, right? So what is capital? Capital is actually equity. And now step number one, identify the nature of the item. What is capital? Step number one, capital is equity. Step number two, identify according to chart whether the item is increasing or decreasing. Capital is increasing in the business, right? So I'm going to look at where is it plus, what is happening? Identify if they're debit or credit. Step number three, if equity increases, that means it's going to be credit. So I'm going to write over here 500,000. There you go. So that was first entry. Everything will happen on 1st of January. Let's just do it like that. Deposited cash 1.5 million in bank on July the 2nd. Cash deposited in bank. Now it doesn't say that whether it's a capital injection or what's really going on. Nothing like that. Okay. So we're going to just pretend that it just came out of nowhere. Boof. Out of nowhere. And cash deposited in the bank, which means that money was available in the form of a cash, but now it has been converted into bank. It has been transferred into bank. Bank is an asset. You can have money either in cash form, bank form, or you can have it in bonds, or you can have it in treasury bills, or whatever. So what is cash? Cash is an asset. What is bank? Having a bank account. Bank account for a company is also an asset. So we identify the nature of items in discussion. They're both assets. Identify according to the chart whether item is increasing or decreasing. So cash is reducing because there was cash. You took the cash and you deposited in the bank, which means cash came down, cash reduced, whereas bank account increased with that cash. So first thing is cash, the other thing is bank. And so identify according to chart whether the item is increasing or decreasing. They're both asset. Uh, Cash is decreasing. When cash decreases, we are going to make it credit. But let's write bank first and cash afterwards. Always debit first, credit afterwards. So cash is actually reducing because cash is now being converted into bank. It's transferred to bank. You no longer have it in the form of cash. 1.5 million alt HK, and this is 1.5 million. Okay. Same thing over here. And bank is increasing. Since it's bank is also an asset is increasing. When an asset increases, you do debit. So we did a debit. There it is. Okay, entry number three, inventory purchases 750,000 on credit from Megamart. Inventory purchase. So when an inventory is purchased and it says inventory purchased 750 on credit, we bought it on credit. So what is happening here is that our inventory is increasing and inventory purchased on credit. That means we have not yet paid for it. And the other thing is Mega Mart. We bought it from, you can see over here, from Mega Mart. Let me bring this over here so it's more clear. Inventory purchase 750 on credit from Mega Mart on 5th of July. Let me change this date to 5. Uh, and the second thing is we now owe money to Mega Mart. Mega Mart. Okay. So when inventory increases, identify the nature of the item in discussion. Inventory. Inventory is an asset. Identify according to chart whether the item is increasing, inventory is increasing, plus, and what happens when asset increases, we debit it. And how much is the amount? 750,000. And the opposite would be the same. Megamart. So now, but what is Megamart? Megamart is a liability, somebody that we owe money to. We owe them money, we have to pay it back. So it's a liability. But what is happening with the liability? Liability is increasing. We now owe them money. It's increasing for us. What happens when a liability increases or is created? It's called credit. So we credited Megamart. You can see I'm putting it under credit. Okay. Inventory purchased. Next step is inventory purchase. Oops. Why? Inventory purchase 500,000 from multimedia on 7th of July. Come on here. 7th July. Inventory purchase from multimedia 500,000. Inventory on cash or bank. Or I'm going to just simply write what are the spelling of purchased. Okay. Inventory purchased. So what's happening is that inventory is increasing and purchased. It could be from bank. It could be from. So since we have more money in the bank, most probably we bought it from bank. So what's happening here? Identify the nature of the item. It's inventory. What is inventory? Inventory is an asset. What is happening to inventory? This asset. It's increasing. Plus, if it's increasing, then what do? We debit it. 500,000. And since we paid it from the bank, what is bank? Identify the nature of the item in discussion. Bank is an asset. Identify what is happening. Is it increasing? We're paying from the bank, so we're taking money out of the bank. So our asset is decreasing. Minus asset is subtracting. What happens when asset goes down? We call it credit. Done. How many entries down? One, two, three, four. Sold inventory on credit, sold inventory on cash. Two items in which we are going to be selling the inventory. Okay, let's just leave this sold, or okay, let's just do it. Finish it. And sold inventory on first one was on credit to Frank. So what is happening over here is that sold inventory on credit to Mr. Frank for 400,000 on July 10th. Let me change the date. So when we sell something, what happens is that it's a sale, right? So we're selling inventory. And so two things are happening. We are having a sales and we're selling on credit to Mr. Frank. So Frank is our customer. Sales is our revenue. So let's deal with Frank first. Frank is our customer. Identify the nature of the item in discussion. Frank is a customer, and if a customer, what is the definition of asset? Asset is anything from which future economic benefit would flow to us. So Frank is an asset, a customer, and from him in future, we are going to get money from him in the future, not now, but in the future, because we're selling it to him in on credit. So in the future or in the present, a future economic benefit is generating. So Frank is an asset. An asset is increasing. That means we have to do a debit. Frank, or we can call it customer. And how much is it we are selling for? 400,000. We determine it's going to be debit, debit. We are doing a sales. What is sales? Sale is actually revenue. right? What happens when revenue increases? Revenue is increasing because we're making a sale. So revenue is being generated. So when revenue is generated, it's called plus. It's increasing. And on the chart, it's saying that when revenue increases, you do a credit. So I'm just simply going to do a credit. And I'm going to call it sales. There you go. And next is sold inventory on cash 300,000 on 14th of July. 14/07/2024. I hope it's right. No, it's not. Down, down. 14th, 14th. Identify according to chart whether the, okay. Uh, Sold inventory on cash for 300,000. Again, two things are happening. We made a sale and we sold it on cash, which means cash is increasing. We got cash. Okay. What is sales? Sales is revenue. We did it. What is cash? Cash is an asset, a future economic benefit. That is the definition of asset. And it's a current economic benefit. We just got it. So what is happening in cash is that it's an asset. Identify the nature. Identify according to chart whether it's increasing or decreasing. It's an asset. It's increasing. That's a plus. And when it's uh, increasing, whether it's being debited or credited, then it's going to be a debit. So I'm going to put over here sold inventory in cash 300,000. 300,000. Okay. Uh, Cash is increasing. Sold inventory inventory on cash. Sold inventory on cash. And what is the other effect? We are making a sales. And what does that mean? Okay, so now sale is revenue. When revenue increases, is revenue increasing? Revenue is increasing. We were making a sale, so it's plus. What happens when revenue increases? It's a credit. You see, every transaction is debit and credit, and we're just staying within the chart. We're not going anywhere here and there. And yet everything is debit or a credit. There is, you won't see an entry with two debits or two credits only. Okay, expense incurred in office of 45,000 on 16th of July. The last orange one. Expense incurred in office. Okie dokie. 14th July. Same? 16th July, sorry. Expenses incurred. Does it say expenses incurred in cash? It doesn't say anything, so I'm going to assume it's all done in cash. Expense is increasing. So two things which are happening I need to identify. Number one, expense. Oops, it shouldn't come here. Number two is I'm paying for the expense in cash. So identify the nature of the items in discussion. Expense is increasing and cash is decreasing. Identify according to chart whether item is increasing or decreasing. Expense increasing, it's a plus. What happens when an expense increases? It gets debited. So I'm going to put over here expenses. How much is the amount? 45,000 debit. Second thing is cash. So we're paying for that expense in cash. So what is cash? Cash is an asset. And what is happening to that asset? It's decreasing, minus. What happens when it's a minus? It gets credited. Expense account, cash account. So these are the accounts that we will be dealing with towards the end. So it's very important to classify the account. Very, very important. Now comes entertainment expense, the one after the orange. Entertainment expense incurred 700,000 on July the 18th. Uh, July 18. Again, expenses. Again, two things are happening. Expenses taking place and there's cash. And I am going to assume that $700,000 worth of 70,000, sorry, not 700, $70,000 is is a huge amount. And instead of cash, let's do this one from bank. Again, expense is increasing, bank is decreasing. It's the same thing as before, but instead of cash, I'm going to take it from bank. Amount is 70,000. One is debit, the other is credit because bank is reducing. The money is going out of the bank and asset is decreasing. When an asset decreases, we do a credit. Sorry, but this is entertainment expense, right? But it's an expense generally. Doesn't matter what kind. Computer purchase for 25,000 on 27th of July. Supercomputer, right? It's 27th of July. Date. Not really very important from where we are sitting. 27th of July. Oh, but why is it suddenly turned to 25? Okay. 27th of July, we have computer purchase. Computer purchased. So what's happening over here? Two things again. Two items. We're dealing with computer. And if we purchased it, we probably paid it. Since it's a big amount, I would say we paid it from the bank account. So what is computer? Computer is an asset for the company. And when an asset increases, we debit it. I'm going to call it computer account and it's being paid from the bank. And bank is an asset and when an asset decreases, we do a credit. So the amount is 25,000. Okay, second last salary paid. And that is done on 1st of August. 018. Salaries paid. So what's happening in the salaries paid? There's again two items we need to identify. Salaries and they're being paid, so which means they're either being paid in cash or from bank, but salaries are mostly paid from the bank. So salary, what is salary? Salary to me is an expense. It's a business expense. So what happens when an expense increases? Expense is increasing, right? You're paying it, so it's an expense that is incurred, that is happening. So it's a positive, it's a plus, it's increasing. So plus minus over here does not signify positive, negative. They actually signify increase or decrease. So salaries are an expense and salary expense is increasing. And when a expense increases, we debit it. And what's the amount? 100, 10,000. And it's again paid from the bank. And what is bank? Bank's an asset. What's happening? It's decreasing by what amount? 110,000. So it's a credit. Rent paid to Mr. Collin on 2nd of August for 35,000. Two things again, rent expense and it's being paid from the bank. Rent is being paid. Rent is an expense. What happens when an expense increases? What is happening? Expense is increasing. Plus, what happens? It's debited. Paid. rent, bank. So I've identified two accounts, rent and bank. Rent is increasing and an expense is being taken care of. So it's 35, oops, 35,000, and bank is decreasing, and when an asset decreases, it's a credit. So those are the sample journal entries that we have passed. Next step is to create a trial balance. So I'm going to go to the next tab, and what I'm going to do first, I'm going to select this all, and I would use a pivot table for this one. Alt and V T. New worksheet. Yes, I want a new worksheet. Okie dokie. And here we are. Sheet number 2 was ledger. This is the trial balance, or TB in short, not tuberculosis. It's a pivot table. So what do I want? The first thing I want is I need to know the accounts, right? Sorry, accounts. Then second thing I need to know is the values, debits, and then the credits. And then I also need to know the sum of the balances. Mm, So this is the trial balance, and as you can see in the trial balance, the sum is 0. As they said that there should be an addition, subtraction, and then you get sum of balance. And we're going to go back to our thing, and you can see, where is it? Oh, so we've created the trial balance. This is what the trial balance is. TR, CR are shorts for debit and credit. I should have mentioned that earlier. So this is TR, this is CR. And that's how we created our, um, and I want to do a format cells, accounting, decimal places, that is correct. Currency, okay, let's do red. If it's a negative value, it will show in red. How about that? Okay. So now you can see the negative values are in red. Control B to make them a bit highlighted. And this also. But capital is naturally negative. Cash, how come cash is in negative? Megamart, sum of credit. Sahi hai bhai. It's okay. Sales is always negative because the balance is credit balance. Okay. So this is your trial balance in essence. And that is what it looks like. So I used Excel to create it. In reality, it's just basically done on word, and trial balance. There you go. So that is how it's done. Now they're saying the book says that there is an adjustment that needs to be passed. So the adjustment thing is very simple. All you do is whatever the amount that you're getting here, you just again, this is on 31st of December. You get this. You got this information. For example, within the adjusting period, as I discussed earlier, there could be like there was some error in the entry. You discovered, oh, this customer thing, this is not correct. For example, we are having cash in negative 745,000. How is the hell is cash going to be negative? That's not possible. So if you sold inventory on cash, so probably something somewhere is wrong. Cash is negative. Cash. You didn't bring as much cash in as much as you pumped out. So when I will go over there, I will change the amount for cash. So I figured out that it could not be 500,000. It has to be 5 million, right? How's cash supposed to be negative? Cash cannot be negative. Trial balance, pivot table option, refresh all, and now it's positive 3.75, bold off. So there you go. Now cash is positive 3.75 million. So this is like an adjustment entry. I did an adjustment entry. So what they're saying is that you have, I'm going to bring it over here, Alt SU, Control B, S, blanks, okay, 0. Okay. So they're saying that this is your first trial balance. This one, the unadjusted trial balance. And then you pass an entry adjustments. For example, I would say that again, debit, credit. So it's saying pass a general entry. So for example, I'm having this is add, there's addition, there's debit for enough, and there's credit of this much. So this is a debit balance. This is a credit balance. This is debit. Computer is debit, 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 credit, debit, debit, credit. Okay, so the ones which we are dealing in duplicate is going to be all DSU. Only the difference would come. Only the final value would come. And I would just add, subtract, and whatever the final value is. So that's what it is now. And they're saying that you pass adjustment entries. For example, if there needs to be an adjustment entry, we figured out that in the bank, there was some 40,000 that we had transferred, but we did not know, nobody told us. But it was in the bank, and we performed a year-end bank reconciliation and figured out there was somebody, some customer deposited 40,000. Anything could happen, right? So we have 40,000 here. So we pass that one journal entry. Then we would say that, for example, expenses, there were a couple of other expenses of $25,000 that nobody told us. And there it is. We added further expenses. and things like that. So they would say then, for example, in computer or in customers, one of the customers had actually paid us money, so we have to reduce the customer had paid, Mr. Frank had paid us $25,000. So since it's debit, we would do to reduce it, we would do 25,000 in the credit, and we would also increase the cash as well, or bank, whatever you like. And yeah, actually, let's do that. 40,000 was deposited by Mr. Frank. There you go. So that's what it's saying. It's saying you do these adjustments, the information that was missing, or some adjusting entries, for example, prepaid insurance, depreciation expense you forgot. So we can add any of those: salary expense, interest payable, accounts receivable. We do all of those adjustment, and then we just do a final add and subtract. So if it's a debit, it's an add, and if it's a credit, it's a subtract, right? And I would bring this down. Similarly, credit plus credit. Yep, no, credit plus credit. Really? Okay. So now we do what that is known as, they're asking a total. And I'm going to go all the way control right. And there's a difference. I probably made a mistake. And I will see it's $15,000 worth of difference. Hmm. Because to every debit there has to be an opposite credit. So we said that expenses were incurred, $25,000. So those expenses must have come out of bank or cash. So I would say they came out of, okay, okay, wait. Even I have made a mistake. If it's a debit, add for a credit. Y minus. And there you go. Now we have all sides equal. So they asked to pass the adjustments. We did the adjustments of 65,000 and we got a final adjusted trial balance of 6.515 million. That's what they are basically talking about. So this is how it's done. We did the practical example for that closing process, and the closing process, this one I told you just have to memorize it. And there it is. So basically what happens is that from the trial balance, you create an income statement. So if I were to create an income statement from it, first of all, I would have to recognize the nature of these items. Come on. Bank is an asset. Capital is capital. cash is an asset, computer is an asset, customer is an asset, it's a receivable, expenses is expenses. So we have to classify them in these five items, these five headers. Inventory is asset, Megamart, what was Megamart? Supplier, rent is expense, salary is expense, sales is revenue. So we prepare financial statement from it. Financial statements are prepared revenue minus cost of goods sold, GP, operating expense, we get net, oops, net profit. This is your income statement. So we say, we would just take figures from here. Revenue, do we have a revenue amount? We have a revenue of 700,000. Do we have cost of goods sold? Apparently we don't have any cost of goods sold. So our GP would be expense minus cost of goods sold. What are our operating expenses? All of our expenses, rent, salaries, rent plus salaries, that is our operating expenses. And then we subtract from our gross profit our operating expense. Really? 555,000 is our, okay. Did I revenue expenses? Did I miss anything? I missed one more expense, which is just expense. And so we can say that, how about that? Salaries is our main business. So we pay salary for whatever the main expense that we have. And instead of adding salaries here, over here we will add this other expenses. And we have to take them on from the final adjusted balances. So our real net profit is $415,000. So when they say closing entries, all temporary accounts, revenue, expenses, withdrawal accounts will be zero balances. Basically, what they mean by that is that you add, subtract all the expenses, revenue, and you come up with a final figure 415,000. This 415,000 would be taken to the balance sheet and added in the balance sheet. So this was my income statement. And then if I were to create my balance sheet, I would have assets on one side, liabilities plus equity on the other side, right? And let's make this bold. What falls in our assets? All of our assets, I would just say, um, we have cash, we have bank, have cash, bank, computer, customer, inventory. These are all our assets, and I would arrange them over here, right? And what is in our bank? I would say bank is 800,000. I would bring my bank over here. What is in my cash? My cash is coming to 375555, whatever. What is the value of my computer? Computer is coming over here to be $25,000 all TSL. What is my customer coming to? 400,000. Oh, and one thing, that there's a debit and there's a credit as well. So technically, um, what's supposed to happen is minus 400,000 because he paid the money, right? So delete from here as well and still tally. 360,000 is my customer value. And it says balance always matches. So you can see 6.475 thousand. It's matching. Inventory is also an asset. So my inventory value is 125 million. There it is. Now let's see what's on the liability and capital creditor. I have only two things that are falling on that side. One is the creditor, the other is equity. So my creditor is valued at 750,000. My equity or my capital is valued at 5 million. So now if I were to add all of these, it should match, but it's not matching. You can see the asset side and the liability side. So the basic concept in balance sheet is that it's supposed to balance and it's not balancing. The numbers are out, or as we call, they're not balancing. So what do we do over here? So what needs to be done is that there is probably some amount missing, and this is where this concept will come. All temporary accounts, revenue expenses, and withdrawal accounts will have zero balances. The capital account will be updated to reflect profit or loss and withdrawals from the period just ending. So temporary accounts which were the temporary accounts? Let's see what they're calling temporary accounts. Temporary revenue expense, withdrawal, income summary. Permanent account, asset, liability, owners, capital. Asset, liability, owners. These are permanent account, and expenses and revenue. Those are all according to it uh, temporary account, and they're closed in the equity account. So how are they closed in the equity account? You see, this is your temporary accounts form part of income statement, permanent accounts form part of balance sheet. Every year income statement changes, there's something new coming here. Whereas in the balance sheet, these balances just are updated to reflect the changes that happened last year. For example, next year bank would have a new balance, but it does not mean this balance goes zero. Of course, you're going to have movement in that. Revenue every year would start from zero. Like revenue this year was 700,000. Next year you made 250,000. So it's like resetting itself from zero. This is what they're saying. But whereas in balance sheet and liability, this balance will be closing for this year and opening balance for next year, which means next year these balances would be there, but the movement like these one, inventory bought, sold, computer bought or sold, customer coming, customer going, paying off, these balances would just change to reflect the changes taking place in the next year. So that is why they're called the permanent account, and these are called the temporary account. Let's put something here as well. Balance sheet, income statement, I want to highlight it. There it is. So, and then it says but how do you account for it? I mean, there is something that happened. What happens to this profit? Where does it go? So profit is the property of the owner. And where is the owner reflected in the entire financial statement? He's reflected in the equity. This is his portion. So this profit also belongs to the owner, which is the capitalist or the equity. So what does it say? Close income summary account to owner's capital account. Close revenue accounts into income summary account, close expenses account into income summary account. Basically what it's saying is revenue, expenses, plus, minus, add, subtract. This is the income summary or the income statement is the same thing. So you have these final balances. This is the closing of the revenue and expenses in the income summary account. This is the income summary account. We're summarizing how all the revenue and expenses generated led to this, and this is called closing amount. 415,000 is the closing amount. Step number 3, closing income summary account to owner's capital account, meaning this amount is to be taken to the owner's value. So I'm going to say add net profit. So we would just simply bring this 415,000 over here. That is called, this is the step number 3, closing income summary account, owner's capital account. That's it. And they did it through these weird tables that they made, but I showed you in a more appropriate manner, in my opinion. All other accounts will remain unchanged. So we did up till that. Post closing trial balance, all temporary accounts have zero balances. We did all of that. Total debits, total credits for permanent account. There it is. Total debits is equal to total of credits. 8.7, 8.7. 65, 65, the adjustments. After adjustment, 6.475, 6.475. All there. Block, block, block. Same here. Done. So this is how it's done. You have the 6.165 million. And you can see, oh, that's supposed to match. Ooh, $25,000 difference, which is because of, uh, oh, yeah. So basically this 25,000 was to be subtracted from the asset. Cash is reducing. So what I was supposed to do was minus this 25,000 and to make it zero from here. So there it is. It's still balancing, right? And you can see the net effect since I was taking all those balances over here through links, right? So that is why it had no effect whatsoever. And now your balance sheet is perfectly balanced. There it is. That's how it's done. And there you see, even after I've been doing this for over 10, 15 years, even I make mistakes. So this is what is complicated about financial statements. People say that it's a mathematical challenge. It's not a mathematical challenge. It's very simple. Did you see me using anything other than plus or minus? Did I even divide? Did I even multiply anything? I didn't do any of those. But this is how the financial statements are prepared. And I and imagine in a company there are thousands and thousands of transactions. I just used what, how many? 11 transactions, and how many times I had to make those changes, right? So in reality, it's very, very tough. And this is the simplest. In reality, balance this financial statement, I've done it on one Excel sheet. I've participated in auditing of companies with financial statements running over 130, 140, 150 pages. So you cannot even imagine the amount of information that is stored in them, and thousands of lines, 10, 20, 30,000 lines. This is how many lines? This is like 10 lines, and imagine having 15, 20, 30,000 lines. Then how hard could it be if you make one mistake somewhere? So that is what is complicated about accounts, that it's like a puzzle. One second, the quantity of the puzzle. So those two things what make accounting tough. So let's finish our topic. Post closing trial balance, that is done. Mini quiz, classified. A classified balance sheet organizes assets and liabilities into important subgroups, provides users with more useful information for decision making. So what they're saying is that it's classified like bank. I can go over and see, oh, 800,000 is in bank. Okay, he has so much cash. Why is he keeping cash with him? Shouldn't he deposit all that money into the bank? Why are you doing that? So this is the advantage of having a financial statement. You look at the final picture. It's like a final picture. Okay, what's going on over here? So first mistake that I took out, I figured out that he shouldn't be having so much cash with him. He should deposit that money in the bank. Second thing that is coming to my mind is that if you have so much money lying around, why don't you just pay off your creditor 750? Take 750,000 from here and pay the creditor and call it a day. That's it. And ask your customer to pay off. So this is how decision making is done. You look at the final picture and it makes sense. Provides users with more useful information for decision. So I just made a decision. Deposit the money into the bank. That's one decision I made. Sections of classified balance sheet: current asset, non-current, property, plant, intangible, liabilities, non-current liability, equity. Current liability, anything that has a life of less than 1 year. Non-current, more than 1 year life. Current asset having a life of less than 1 year. Non-current investments, more than 1 year. Property, plant, equipment, more than 1 year life, like 50, 60, 100 years. Intangible, the example of intangible is royalties, trademarks, patents. These are intangible assets. They have a value. You can take that off formula. You discover something and you have a particular formula, like McDonald's and KFC's. They have special recipes for some secret sauce or whatever that's proprietary, and they say we will not give it to you. So if somebody went and bought these companies, the recipes would be in the valued as intangible assets. Don't ask me how they calculate the cost of it. Mm, no offense, but this is stupid. That's not how it works. I've worked in billion-dollar organizations. This does not make sense, to be honest, but memorize it. You're going to get tested. Property, plant, equipment, we've already been through it. Intangible, current liabilities or obligations due to be paid or settled within the longer of 1 year or the company's operating cycle. Operating cycle is single year. Non-current liabilities are obligations due beyond the longer of 1 year or the company's operating cycle that is more than 1 year. Equities owner's claim on the asset. Correct. Review. Ratio. Current ratio that is used to evaluate a company's ability to pay its short-term obligation. You just have to memorize it. That's all I can say. Current asset divided by current liability. So these are current assets. This is current liability. So the sum of current assets, I will just take this minus one non-current asset of 25,000 divided by current liabilities. Current asset divided by current liabilities. Okay. So this divided by current liability 8.8 times. So basically what the how you interpret a ratio is that the current assets have 8 times the ability to pay off their current liabilities. This is basically the point of having this ratio is that how many times can your current because why do we need this ratio is that in case your current liability which is to be due and which is due in within 1 year, if they come knocking at your door and asking for, hey, where's my money, give it to me. So how do you have enough current asset, because current asset is something that could be sold or converted into cash rather quickly. But for example, if you want to sell a $50 million property plant, then how do you sell it? Do you think you can sell it within a week? No. So what can you have readily available to settle some liability within a week or 2 weeks? Your bank account, your cash account. You can sell inventory very quickly. Can you sell computer very quickly? If I wanted to sell my laptop, I think it would take me 3 4 weeks, even in this economy. So that is like asset cannot be sold that easily. So you this is known as liquidity. How quickly can anything be turned into the most liquid form, that is the cash? And if the creditors come knocking at your door, how many times does your current asset or your most liquid assets could cover your liability? If it's less than 1%, you are in trouble, you're managing your company poorly. But if it's more than 1%, then you're doing good. That is basically the purpose of it. So this is how uh, the financial investors, they just look at the ratio and they say, okay, if it's coming more than one, okay, if it's covering more than 2 times, then it's very very good. You're doing an excellent job. You will not leave if it's less than 1 times, which those companies end up borrowing those short-term revolving credits from bank facilities, because they know that means the payment to the creditor would be faster and more than their current asset would be able to cover it. So they would need, those are the companies that go to banks for line of credit, revolving line of credits, and that incurs, of course, you have to pay interest on that money. Nothing is for free, and that's an added expense to your company. So then we say you're performing poorly. This is the advantage of current ratio to see how they're managing the company. This ratio should not be used in isolation as a measure of liquidity, as we discussed. That is what that means is that I discussed about the liquidity aspect of it. Will vary from industry to industry. It also depends on industry and may be tracked over time to spot trends, may be used to compare to industry norms. Quick ratio, a current ratio that includes assets that are easily convertible to cash, equitables, marketable securities, account receivable divided by current liabilities. So current assets have many classes, but quick ratio, they say, are all about the most liquid assets. So there are some assets which are not most, you can see there is no inventory added in this one. Because even inventory, if I went to sell my inventory, that would take me some time. Whereas account receivable, marketable securities, I can just simply come knocking at my doors. I can just simply hand him cash, gold, equivalent of cash could be cash or cash equivalent like T-bills, treasury bills, your bonds, securities, things like that. I could just simply hand him over and I could say, okay, go sell it in the market yourself if you don't trust me. Or accounts receivable can be sold. You can sometimes lend your debtor to a company that would charge you a fees, and in turn they would be responsible for getting money from your debtors. And so that's called factoring, but we are not going to do that. And that is why accounts receivable are also considered liquid. You could quickly sell them to debt collectors and get the money, and it's their responsibility to get the money. So that is done. Debt to equity ratio, total debt over total equity, which means a ratio that indicates the risk of position of a company. Basically, what this is doing is that all the debt you have, if your company went bankrupt, and those who owe those people to whom you owe money, they come knocking at your door. Can you cover it from your equity portion? So over here, if the creditors come knocking at my door, I have 5 million in my equity, and I just made a profit of $415,000. So yeah, I can pay off. So my the ratio would be, how would I do this? Total debt over total equity. Total debt divided by, I'm going to add these two and then close the bracket, and it says 13%. This one is measured in percentage. So my debt is only 14% of my total equity. So which means I'm doing really good here. It's very small. When you go and try to get the loan for your house, the ratio, let me tell you, is 40%. Your total, they would add um, uh, they would assume that the mortgage would, for example, cost $2,500 per month. So they would say that this should be 40% of your total income. That is, you divide this by 0.40, and you must have an income of $6,250. Otherwise, you will not be able to mortgage. So, and your credit score should be like 700 plus to mortgage a house. So this is how they do it. So over here it's 14%. So this is what the what is called the debt to equity ratio is called. And you need that also in your life if you're interested in buying a house or something. Okay. Reversing entries prepared on the first day of the new accounting period, prepared for adjusting entries that create accrued asset. Optional entries used to simplify record for keeping. Accounts receivable to rent revenue. This is the entry to record accrued revenue. Account receivable, rent revenue. Account receivable is an asset, so it's debit. Rent revenue, revenue is increasing, so it's a credit. And this is they're saying, oh, okay, how do we reverse it? The best way to reverse it is just simply do the opposite transaction. Rent revenue debit, account receivable credit. What they've done is incorrect. Reversing means doing the exact opposite, right? So if you want to reverse it, rent revenue debit, account receivable credit. And this is how the net impact. No entry. The other way is reversing entries are not used, reversing entries are used. No entry, cash account, receivable, cash to rent revenue. This we discussed in the last topic as well. Remember in which I showed you if we do not do the reversing, this one, we would subtract, we would take out one entry from here and the net effect would be the same. So that is the one they're talking about. And summary describes and prepare worksheet, explains its usefulness, describes the closing process, so on and so forth. So that is it. And should you have any questions, any answers you need, let me know. Thank you.